Good afternoon, ladies and gentlemen. On behalf of Ambit Capital, we welcome you all to the Q4 FY22 earnings call of EIH Limited. We have with us Mr. Vikram Oberoi, Managing Director and Chief Executive Officer, and Mr. Kallol Kundu, Chief Financial Officer of the company. A brief disclaimer before we start. We would like to inform you that the management may make certain comments on this webinar that one could deem as forward-looking statements. Specifically, the financial guidance and any pro forma information that the management will provide on this webinar are their estimates based on certain assumptions and have not been subjected to any audit, review or examination procedures. Please be advised that the company's actual results might differ from these statements, and EIH does not guarantee these statements or results, also is not obliged to update them at any time. I will now hand over the call to the webinar to the management for their opening comments, post which we can set the floor open for Q&A. Thank you, and over to you, Vikram sir and Kallol sir.
Sure. Thanks so much, Karan. Good afternoon, ladies and gentlemen, and thank you for joining us on the call. Kallol, should I just make some quick opening remarks?
Sure, Vikram.
Before you go through the presentation. So, we've all been, or our industry has been through 2 years of COVID, and fortunately, both corporate business and leisure business have picked up. When we look at the past 2 years, what really kept Indian hotels and Oberoi Hotels and Trident Hotels going was the large demand within the domestic market. We saw a strong demand for our leisure hotels, whether that was Trident or within the Trident or the Oberoi brands. Whereas corporate travel was really restricted, people were working through other means like we are doing today, and corporate travel took some time to resume. I think India's vaccination drive, the low counts of COVID or the low counts of hospitalization have really seen that turn, and we saw a significant upturn in corporate business starting in March, and that trend continues today as well, with strong demand even in our city hotels, driven by both corporate and the MICE segments. The other thing that's come to us as a positive surprise is the return of both international corporate business as well as international leisure business to our hotels and to India. We hadn't really anticipated this would happen as quickly as it has. For leisure, we were looking at quarter 3 of this financial year, and for corporate business, it was the second half of the year. But we've been pleasantly surprised in our hotels where, like Delhi, Bombay, Rajasthan, Agra, etc., where you get foreign travel coming in. These numbers have picked up far greater or far more quickly than we had anticipated. So we hope this coming financial year 23 will be a good year for us and as well for our industry after COVID. We also hope that there are no variants that cause significant hospitalization either in India or overseas. And if that continues as is, I think this financial year will be a very positive year for EIH and for the industry as a whole. With that, Kallol, I'll pass it on to you to go through the financial results, etc., which are part of your presentation.
Thank you, Vikram. Good afternoon, ladies and gentlemen. Warm welcome to all of you to this conference call. I'll begin with the key highlights for the quarter 4 of financial year 22, where we see domestic air traffic increased by 38%, as per HVS ANAROCK report during March 22. The nationwide hotel occupancy for the first time crossed 60% on an overall basis since the onset of the pandemic, sometime during this quarter of FY22. The return of big ticket conferences and events such as the IPL drove Mumbai's occupancy to pre-pandemic levels for the month. The city, along with Pune, saw the greatest increase in occupancy in March 22 compared to the previous year. And as Vikram mentioned, improving corporate travel demand is also assisting in occupancy movements. Compared to the hospitality industry as a whole, our company's RevPAR growth has been higher. Fortunately for us, during the last 3 months of financial year 22, where we see the ADR and occupancy and resultantly the RevPAR grow by about 88% on an average in March. For the industry, the same has grown by between 108 to 148% at EIH. And the RevPAR index continues to be high as compared to the industry in general at about 2.5 times, which has substantially increased from 1.95 to 2 times of last year. The relative indices to competition, in case of domestic hotels, the data presented here is for all the domestic hotels of which are owned or managed by EIH Limited. This shows a trend from April 2019 to March 2022, where we are happy to share that the RGI has been by and large, except 1 month of June 2020, it's always been above the dotted line of 1, which shows that the index is at a higher pace than what the industry has been doing or what our competition has been doing. And obviously, when you go through these charts in detail, probably there'll be more questions which we'll be happy to then answer. Our outlook continues to revolve around our 3-pronged strategy of endure, revitalize, and flourish. When we talk of enduring, we continue to speak of our strong balance sheet, our strong asset base. The slight decrease that you see here at between 21 and 22 is because of sale of one of our core non-core asset, the EIH printing press. But despite all of that, I think the bank debt has been at very reasonable levels. The bank net debt at 270 crores. The net worth continues to be high and positive. And the robustness of our balance sheet have helped in controlling the finance costs, and as a result of which we do enjoy very competitive rates from our banks. The weighted average cost of debt as on 31st March 22 was 7%, which is a reduction of about 90 basis points in the last 1 year. The other thing that has helped us and we've been talking about it in the past, towards our endurance, is our ability to improve on our operational efficiencies, on all aspects of operational efficiencies. And as numbers at the bottom of the grid would show, that the total expenses vis-a-vis FY20 has reduced in FY22 by about 22%. Our corporate costs in the same period have reduced by about 22% again. And total fixed costs, we have something been consistently been talking about, is the reduction in fixed costs has been 15% vis-a-vis FY20. This means that this would tantamount to a significant quantum in number, in absolute value. How much of this is sustainable in the long run is something that internally we are working on in the organization, but we believe that a substantial part of this will remain as such going forward. The third facet of our endurance has been our ability to maintain the highest standards of health and safety. And we are happy to share then that 5 audits were conducted during October 2020 to April 2022. And the good thing is that every single Oberoi and Trident hotel has received the highest safety and hygiene rating, which is platinum by Bureau Veritas. So all in all, as a result of all this, our guests continue to repose their faith in us. And of course, adding to that, we initiated efforts even during this period of COVID, whereby we looked at energy conservation, carbon footprint. 4 of our hotels that 2 of them we own and all 4 of them we manage, of course, where we have commissioned solar plants, where the generation of electricity is close to 35 to 40%, which is completely through solar, where this has helped in reduction of our average cost reducing from about 11 rupees on an average to about 6.6 rupees per unit. The number of hotels which consume renewable energy today in the group are the Oberoi Gurgaon and Trident Gurgaon, which are 100% on solar energy, which are managed by EIH. Oberoi Banivilas, Uday Vilas, Trident Tower and Trident Udaipur, as we've mentioned here. The Oberoi Bengaluru, Trident Chennai, OFS Chennai, these are on wind power. So a substantial part of our initiatives in the energy conservation side, or ESG initiatives as they call it, is really something that we are looking forward to within the company. We do talk of being revitalized, as would be evident from the sharp RevPAR recovery post third wave of COVID-19, which clearly shows the impact of each wave as it came. The 2 bars that you can see are for owned hotels of EIH, and the other one is the domestic hotels in India, including managed hotels. And all of these, you would see the recovery which is there after the third wave has been pretty good, especially in the month of February and March. There are several kinds of analysis that we've provided, and I'm sure all our friends would like to go through them and come back to us with questions, if any. The recovery in ARR and occupancy, the previous slide was on RevPAR, so that's broken up into ARR and occupancy in domestic hotels. And as you can see here, FY22 is represented by the red color in occupancy as well as in ARR. So both are seeing a significant increase and uptake, both in occupancy as well as in ARR. City-wise, if you were to look at it, the revenue recovery has also been good. And like Mr. Vikram Oberoi mentioned, the leaders were, in this case, Maharashtra and NCR, followed by other cities like other leisure locations where we are placed, like Udaipur, Jaipur, Shimla and Chandigarh. There's been an uptake in Bengaluru and Hyderabad as well. The overall operating matrices, if we were to compare them between the various categories of hotels that we have, as we classify them traditionally as Oberoi Metro properties, Oberoi Leisure properties, or the Vilas properties, Trident Metro properties, Trident Leisure, Trident City, and others, and followed by a total. So again, this again shows from a slightly different point of view as to what the various kinds of recoveries have been across different categories of our hotels. Food and beverage business in domestic hotels, including managed hotels, also continues to be robust, with an increase of revenues that we are seeing in FY22. In fact, it stands at 58 crore, which is amongst the highest in several years. When we talk of Flourish, the third leg of our recovery process, there are several key initiatives that has been launched under the Book Direct, the Best Rate Promise. A special mention for the Oberoi Select, which has really been very popular and therefore has been now brought out in its second avatar. The Oberoi One is now picking up post opening up from after the pandemic. There are strong tailwinds in corporate and MICE, and I think this graph is pretty revealing. It gives a picture of 1 year as to how the various segments have moved. And clearly the happy thing is that the city hotels are beginning to pick up with an increase in MICE and corporate business. Leisure has, of course, maintained its momentum, and direct too has maintained its momentum. Overall, the performance highlights, these have been published, so I won't spend much time talking about it. While on a standalone basis, the PAT was a loss of 7.3 crores. This included exceptional items of 13.2 crores, which has been highlighted in the notes, which has been published along with the results in the stock exchange. On a standalone basis, this gives a picture of the results quarter-on-quarter for revenue, EBITDA, PBT, and PAT. Of course, the last quarter, the dip vis-à-vis the third quarter is because of January, which was really saw some effect from the Omicron virus. But on a consolidated basis, we have a positive total comprehensive income of 27 crores in quarter 4. The 12-month, of course, was a loss. Again, similar kind of results as we saw in standalone, except that the PAT here is positive. One last point that I would like to make is that the process of looking at non-core assets and unlocking value from them has been taken as conscious decisions. So the printing press was the first one to go off the block, where we had a net gain of 55 crores. This is going to definitely improve our profitability in the periods going forward, because in the last few years, this unit was having EBITDA losses. And therefore, we believe that this is, on a corporate strategy side, this is a good thing for the company. The business blueprint is like the corporate structure is as it has been. There's no major change here. We continue to have about 4,512 keys and 749 keys under the Oberoi brand across the globe. Thank you so much, and we'll be happy to answer any questions that anybody may have.
Thank you for the detailed opening comments. We will now begin the Q&A session. Anybody who wishes to ask a question can raise your hand, and then your line will be unmuted. We'll wait for a while the question queue assembles. So we have the first question from Vikas Ahuja. Vikas, if you can please unmute your line and ask the question. Thank you.
Yeah, hi. Thank you for the opportunity. Hi, sir. This is Vikas from Antique. So my first question is related to the margins. So if I compare the margins, we have achieved this in single digit on consolidated basis. And if I look at your peers who have reported, they are closer to 18 to 20% EBITDA margins. So what am I missing? I mean, why our margins are kind of lower compared to the peers? This quarter, one of you talked about around 12 crore, but there's anything else besides that?
Kallol, do you want me to?
Sure, Vikram.
So I think one of the things is, if you're referring to EIH hotels, EIH's portfolio is 95%, or in fact, 95% of our room inventory is our city hotels. 5%, they're 2 leisure hotels that are owned and managed by EIH, which is Uday Vilas and Vanya Vilas. Uday Vilas has 87 keys, and Vanya Vilas has 25 keys. Other than that, our hotels are all in metro locations where you're highly dependent on corporate travel. So margins are a function of 2 things. It's a function of your top line and your bottom line. And because of our large skew towards our city hotels that are highly dependent on corporate travel, till that didn't resume in March, obviously margins were squeezed. Also during Omicron, for example, and also the Delta wave in April and May of last financial year, or 2022, that's the first thing that got impacted. In fact, leisure hotels didn't suffer as much. So it's really a function of both top line and bottom line, or revenue and expenses. And I think, Kallol, we didn't put the charts in for that showed the significant initiatives that we ran on at least some major expenses. I don't know if you have those readily available and you can run through the numbers. If you want to add anything beyond that, please feel free to do so.
Thank you, Vikram. Yeah, there are 2 points I would like to add. One is, when you do a comparison, I think one of the factors that we mentioned was we are looking at our non-core assets. So when you look at our standalone accounts and you refer to the standalone accounts, by the way, it's not in single digits, it's in low double digits, the EBITDA percentage. But that includes the loss that basically we incur from the Oberoi flight services. So I think an apple-to-apple comparison would actually be to take out the flight services number and then do a comparison, in which case you will find it's much more comparable. And it would actually be even better because there's one expense which probably I must highlight here, that in the employee expense, there's a 7.5 crore expense, which is on account of a one-time payout because the printing press came to a closure. So that's not a regular expense. If that were to be removed, then overall, I think the EBITDA margins are pretty healthy, subject to the points that Mr. Vikram Oberoi made.
And I think also the printing press, which now we don't have anymore.
Till 31st we had, so yeah. So up to that's right. I mean, up to 31st March, there was a contribution to the loss from the printing press as well.
Sure, that's helpful. And secondly, this question is from more of a medium term. So if I look at your, pre-COVID margins, we used to do close to around 20%. Some years it was a little down or up. But also you have highlighted the saving in terms of the payroll cost and corporate structure.
Sorry, you're on mute. Yeah.
Yeah. Can you hear me now?
Yes.
Yeah. So I was just talking about, our EBITDA margin, which used to be closer to 20% pre-COVID. Now, with some of these savings, especially in terms of payroll cost and all, can you put some color on what are the puts and takes for the margin in terms of the medium term would be? I mean, is it fair to assume that now post-COVID margins would be much better than what we used to do pre-COVID, and there could be maybe a 400 basis point improvement we can see in maybe 3 to 5 years from the past? And I'm assuming, a full blown recovery and not, so not assuming any fourth wave or something.
Claude, you want me to?
Please, Vikram.
Yeah. I'm a bit mindful about what I can say and what I can't say about the future. But really there are two parts to it. One is whatever we've seen in the recovery, which has taken place in March and April, our hotels, and we watch STR on an everyday basis. Our hotels are performing certainly on top line or RevPAR better than others in most of our city locations, if not all of them. And I don't have the chart in front of me where STR won. So that's a function of revenue. And on the cost side, many of the initiatives that we've undertaken, whether that's at our corporate office or at our hotels, a large part of that will be sustained even with the recovery. And I think this hasn't finished for us here. We will continue to see how we can drive additional efficiency, particularly on our corporate side, and how we can ensure that the assets and the investments that we've made give a return. So those are the areas that we continue to look at.
So I'll just add one more point to that, Vikram, if I may.
Yeah,
it's
please.
Basically, yeah. So if you follow the trend of what we've tried to highlight in our presentation, it shows a buoyancy in terms of rates, room rates specifically. And because at one level we have reached a point where our costs have really been optimized to a large extent, and of course will continue to be looked at, as Mr. Vikram Oberoi said. Therefore, one can assume that the baseline has already been set. So therefore, any uptake in revenue beyond what we are doing is going to directly flow to EBITDA. So therefore, there is very little, I would say, fixed cost that would be incurred to earn that additional revenue that we are today earning or wherever the rates are going up. Obviously anything that is incremental will add up to your bottom line and will improve your EBITDA margins. Also, you've talked of EBITDA as a margin, but I would also like to highlight the fact that our returns on capital employed, et cetera, are also things that need to be looked at, because we are looking very closely at the opportunities that lie in front of us insofar as what can be done in terms of structuring and restructuring. And that is also beginning to yield results for us as we speak.
Sure, thanks. That's very helpful. One last question. So your competitor have highlighted during their results that April and May, the corporate travel has picked up for them significantly, and it's actually better than pre-COVID levels for them. Are we witnessing the same trend? And also, if we can just talk about the pipeline of room additions we have, maybe from 3-4 years per se, and maybe any kind of a rough estimate around that would be helpful. Thank you.
Let me break this up into two parts. Let's talk about our city hotels first, which are the bulk of EIH owned and managed hotels. In a number of hotels, not all of them, but we've had, forget about 1920, we've had our best years ever that on record. So there's been significant increase in average room rates and occupancies, and therefore profitability for those hotels. And like I mentioned to you, we watch STR, and if I'm not mistaken, in the month of April, every single Oberoi City hotel, every single one of them that is owned by EIH, other than Trident Bandra Kulra, was STR1.
Thank you. And on the pipeline, if we can get some rough.
Well, we have a number of projects in mind. One is we're doing Rajgarh, and I'm talking about EIH hotels. Now, there's Rajgarh Palace, where work is underway. We're also looking at Hebel, which is an amazing site overlooking the lake, where we can develop 1 million square feet. So these are the two ones. We also have a site in Goa, and we're really looking at what we do with that site in Goa as well. Kallol, I don't know if you want to add. I've just covered the main ones, not the small hotels.
So there are some hotels that are being looked at, some projects in some of our subsidiary companies as well. But since this is a meeting of the EIH, therefore we'll probably limit it to EIH.
Thank you.
Thanks.
We'll take the next question from the line of Amit Agarwal. Amit, if you could please restrict your questions to 2. We have a long queue. Thank you.
Oh, can you hear me?
Yes, we can hear you, Amit.
Good afternoon, Mr. Vikram Oberoi and Mr. Kallol. How are you?
Good afternoon, Amit. How are you?
How are you? Good, thank you. I just wanted to know about Cuckoo. Has the plans been formed for the expansion? It's been 6 months, and somehow I visited. I was in Bombay and I visited Cuckoo. You're doing a wonderful job, and your team is an excellent job.
Thank you.
What are the plans for expansion for the same?
So I think in one of the previous meetings I'd mentioned on expansion of Cuckoo, and this isn't about an expansion over a year on year. I think long term we want to establish Cuckoo and grow Cuckoo long term. Cuckoo is the mall has the Geo Mall has had they've also had issues with Omicron, so that's restricted the number of people. But again, now touch wood, it's good. But the Apple store, which is the key anchor store in the mall, has still not opened, and I'm sure that'll bring significant more footfalls. But I think long term our goal remains the same as what I'd expressed earlier on, to really expand Cuckoo into a brand across locations in India.
But do you have some vision for next 5 years? 5 places, 10 places, 20? Otherwise, we can be just having 2 cocos and 3 cocos 5 years down the line. That is as good as insignificant.
Yeah, no, I completely agree, Amit. And we've identified locations that go beyond 2 and 3 for expansion of cuckoo over the next 5 years. We've done it city by city, location by location, and we do have that. I think really our focus is to get the first cuckoo right, and no matter how much we know, we always learn. One of the things that we had anticipated was there would be significant higher demand for confectionery, confectionery items, pastry items. The reality actually is that there was far greater demand for food, so we made changes to accommodate that, and we've seen a corresponding impact on sale. I think of it as a tree. If you think of a tree, they're trees that grow very fast but don't have deep roots, and those trees tend to suffer if there's high winds. It's much better to establish our roots first. And we're not here for the short term. As you know, EIH is not, and our whole management approach isn't short term. We want to get it right. We want to provide the best to our guests. And we want to learn and then roll out our expansion. So we're still, I would say, in the phase of learning, but we have a very clear idea of where we want to go. But let's first make the first one a success, rather than focusing on growth just for the sake of growth.
And one more thing regarding cuckoo only. I saw Cocoa Cart doing the same thing just in every mall, and it's already at the airports. It's already in Delhi, Bombay. So I hope because they're similar name and they're doing a similar thing. So are you aware of the competition of this Cocoa Cart?
No, I wasn't aware. It's called Cuckoo Cart.
Cocoa Cart, Cocoa Cafe.
Cocoa. No, I'm not aware of Cocoa.
It's everywhere. It's in Bombay. It's in Delhi City Walk. It's at Bombay Every Mall.
And what is it, Amit?
They're Cocoa Cafe. They're Cocoa Cart. They're Cocoa confectionaries. All three. Like
I will certainly have a look. I'm not aware of it. I'll make sure.
Domestic Bombay Airport. They're at City Walk. They're at Bombay. Many malls.
Yeah, I'll go and have a look. I'm not
with
aware.
a similar name. So I spoke to 2 or 3 people in Bombay. So they take it as cuckoo rather than Cocoa. They take it as the main.
How do you spell it? Could you just tell me the spelling?
COCO.
Oh, so it's exactly the same.
Yeah.
Okay.
And Cafe and Cart. They have two brands.
Okay, that's very good to know, because I'm surprised that they're using cuckoo as a name.
I think they're 2 friends. They started this business for 3 years, and I think they are in many locations around the country now.
Right. Okay. No, we will certainly look at that. Thank you for pointing that out.
Amit, maybe we can take that offline. Thank you.
And my another question is
Amit, if you can please come back in the queue. I think we have a long queue of investors in the.
Okay, if you want. Okay.
We have the next question from the line of Achal Kumar. Achal, if you can please restrict the questions to 2. Thank you.
Hi. Good afternoon, Mr. Oberoi, and good afternoon, Mr. Kalol. Hi. This is Achal from HSBC. So I, of course, as instructor, of course, I'll restrict to 2 questions. The first of all on the optimism versus pessimism. So now of course most of the hotels are sort of saying that or rather more optimistic about the kind of recovery. Now so on that point I have 2 questions actually. So on the recovery itself, first of all. So how much of your business was coming from inbound international tourism pre-COVID, and now I understand that the recovery has still still we are far from where we were pre-COVID levels. So do you think there is a reason to be very, very optimistic, once the recovery starts, and then we can sort of have a strong recovery or strong uplift to our numbers once the inbound international tourism starts? And similar on those lines, given that capacity still remains constrained, and that's the message we are getting from, whether it's from STR or from all the consultants. So do you think that is another reason we should believe that, oh my God, the capacity is constrained and the demand is rising, so the ARRs would benefit from that also? So that is my first question. If you could please share your thoughts on that.
First of all, hello, Achal. How I trust you're well. So your first question was really on the optimism and related to foreign or inbound business into India. Like I mentioned in the opening remarks, actually, we were surprised at even in March, when things were just opening up for inbound travel, and also in April, the inbound business, both domestic and leisure, in fact, led by corporate, was stronger than leisure, first of all. And obviously leisure is, we're in the middle of or beginning summer. It's not the ideal time for people to travel to India. But we were surprised at the number of guests and the percentage of occupancy of foreign guests in our hotels that attract these numbers, or that attract foreign travel. So that came as a very pleasant surprise. We never anticipated it to be as great as it is. And if that trend continues, I think it's very, very positive for us and for others as well. If I remember correctly, and Kalol, you'll need to correct me if I'm wrong, but it's about 55% historically of foreign, 45% of leisure. During COVID, it was, of course, sorry, what am I saying? Indian and foreign. So it was 55% foreign, 45% domestic. During COVID, it was primarily all domestic. And like I mentioned, those numbers are positive even in March and April of this year. And in between March and April, we also saw growth for foreign corporate business as well as foreign leisure business in our hotels.
So do you mean, Mr. Oberoi, that that 55% of the foreign travel or 55% of the total revenue which used to come from foreign is already back, or do you think that we were still far away from that?
No, it's not back, and this was year round. And like I said, India is seasonal. Even for our corporate hotels, foreign business picks up significantly more between October and March. But what I'm saying is that we're surprised at how quickly both foreign corporate and foreign leisure have returned in March and April. Are they at pre-COVID levels? Absolutely not. So if I implied that they're pre-COVID levels, that is not correct. And I apologize if I implied that.
Okay. My second question is around the loyalty program. Now, given that the situation we are in, what are your thoughts about the focus on the loyalty programs? How important loyalty programs would be? How they would feed into our recoveries and the revenues and the profits? So, what are your thoughts on the loyalty programs?
I haven't. Are loyalty programs important? Is that the question? Or
yeah, I mean, now given the current scenario, given the current trend, I mean, how important are the loyalty programs going to be? I mean, how much focus do you think the hotel operators or maybe airlines or whatever it is would be giving to the loyalty program, and how would those feed into the profitability and the numbers? What are your thoughts on that?
So let me just start by when we were launching Oberoi One, in fact, prior to launching Oberoi One, with our guests, so we didn't talk to other guests, but we spoke to our guests, and it was largely qualitative in nature. So it was administered through a questionnaire, quite a detailed questionnaire, on which we got, I think, an over 50% response, a large sample size, which means that the margin of error is small, and the level of certainty is high statistically. But when we administered these questionnaires, loyalty was not a key driver of selecting a hotel, either for corporate or for leisure. I think for us, where loyalty comes in as very, very important, or a recognition program, is today guests can use multiple channels to make a reservation. And unless the name and all the details match, you may have a separate profile for the same guest. But what a loyalty program allows us to do, or a recognition program allows us to do, is make sure that every time that guest stays with us, he or she is recognized, and especially amongst our more valuable guests, which are in the platinum tier or in the gold tier, how we can provide an incredible experience to them. Because these guests come and stay with us often. They are also our highest spending guests. They stay in the highest category of rooms and suites and spend the most amount of money on food and beverage. And they also are our brand ambassadors. So how do we make sure that they have the most amazing experience when they come and stay at our hotels? And I think that's a very, very important consideration for us in administering this loyalty program, or the recognition program, which is the one at Oberoi. So it's not a points-based program at Oberoi Hotels. It's a recognition-based program at Oberoi Hotels, similar to what some of the other luxury hotel brands have.
Right. Perfect. Thank you, Mr. Oberoi. I'll come back in the queue since the queue is long. Thanks.
Thanks, Achal. Thank you so much.
Thank you. We take the next question from Prateek Podar and then from Rajiv Bharti. Prateek, if you can please unmute your line.
Yeah. Hi. Am I audible?
Yeah, Prateek, we can hear you.
Yeah. So thanks for this opportunity. I just have one question. In your view, what is the sustainability of the numbers which the industry has seen in the month of March and April? Do you believe these trends are here to stay and they will only get stronger as the recovery takes place?
So Prateek, let me just break that. Kalol, please, I feel bad that I'm the only one talking, so please just barge in and...
This is your area, Vikram. No issues.
No, but we can do it together. So it's a team effort. It's never one or the other. So please feel free to add. So again, I'd like to just point out two things in this. One is we have been pleasantly surprised by how strong demand has been in our city hotels across location. That's the first thing. And the only hotel that hasn't performed as well is Trident Bandra Kulra. We had a buyout there, and when this took place, we hadn't anticipated the strong recovery. But other than that, every single hotel has performed very, very well, both on occupancy and rate. In cities like Calcutta, I still think there's an opportunity to further drive average room rate. Occupancies have been strong, so there may be an opportunity to increase rate in Calcutta. But in all other markets, rates have been very, very strong, and occupancies have been very strong. That's as far as city hotels go. I think the other thing that we've noticed is that with borders opening up, with the ability of guests to travel more seamlessly across location or across geography, what we've also seen is that leisure hotels we've seen occupancies fall, and this is even at a hotel like Uday Vilas, which is probably amongst the highest RevPARs of any hotel in India. And certainly STR1 on RevPAR in Udaipur. Last financial year, Udaipur closed at STR1 in Udaipur. Other than Simla, where demand is still strong, Rajasthan, we've seen occupancies come down. That may simply be because we're entering the hottest months, or it may well be that people are now looking at going overseas or to other locations. I think that's something that we need to be mindful for hotels where hotels that are present in leisure locations. That hasn't happened in Simla, like I said, but we have experienced that in our Rajasthan hotels.
And sort of follow-up, you talked about Trident BKC having a buyout. Is this the IPL thing which you were referring to?
This is the IPL, yes.
But had the entire hotel been sold out, or it would have been a part, right?
The entire hotel.
Oh.
We created a bio bubble at the Trident in Bandra Kurla.
Got it. Thank you. Thank you so much.
Thank you. We'll take the next question from Rajiv Bharti. Rajiv, if you can please unmute your line.
Hello, am I audible?
Yes, Rajiv, we can hear you.
Yeah, good afternoon, sir. Thanks for the opportunity. So my question is in continuation to the previous participant's question. So if you look at slide number 16, where you share ARR and occupancy recovery. So if we compare, let's say, the leisure assets, which is Oberoi and Trident separately. So if we see the ARRs have been, in the sense, ARRs have been dropping on a YOY basis on the Oberoi leisure side. But while the Trident leisure, we have seen that the ARR is basically between 17 to 25% up as compared to pre-COVID levels for the last 4 quarters. But the same number for Oberoi leisure was 16 to 30% higher in Q1, Q2, and now we are below pre-COVID levels in terms of ARR. Although the occupancy is stronger and the occupancy is holding up 7% higher than the pre-COVID levels. What am I missing in terms of the two leisure assets?
So I think the key thing you're missing is that in winter, traditionally, so pre-COVID, I'll just give you some broad numbers. If Oberoi leisure hotels were doing, let's say, 28,000 in pre-COVID summer, they would, what are the numbers shown on the chart? If we can just put that up on below. We can just refer to the exact, because I'm going by memory. What was the ARR pre-COVID in the summer, Kalol, for Oberoi leisure?
I think, firstly, let me get it right. Rajiv, are you referring to slide 15?
Oh, yeah. So, yes, the one which is seen here. Yeah.
So I think the question is on quarter 4, Vikram.
Okay, quarter 4. Then it's very, very easy to answer. So the pre-COVID, or let me again take one step back and start where what I was saying. Pre-COVID, you would see rates driven by foreign travel to India, which would start in October through to March, with November and February being the 2 strongest months. And you'd see a sharp rise in average room rates. And if you look at historic data, you will see that certainly for us, and I would imagine for others as well. The whole industry, or Taj and us and Leela, would significantly take their rates up. So in Q4, we were already at a very, very high rate in pre-COVID. So any upside is very limited. Whereas in the summer months, because there was no opportunity for people to go to other locations, even in summer, we were able to charge high rates in Oberoi leisure hotels. As far as your point on Trident, that's being driven by Trident Udaipur that went under renovation. And we saw a sharp increase, if I remember correctly, and can I give rates, Kalol? or better not to, right? But we saw a sharp increase in rates at Trident Udaipur post the renovation and particularly in Q4, driven by not only domestic leisure, but also by weddings and social events.
Perfect. And my second question is on the flight services business. If you can give some headline numbers there in terms of revenue, PAT, PBT, and what is the utilization and what is the capacity here?
Kallol, do you want to just run through those? I don't know if you have those handy.
Yeah, I would be able to give numbers. So again, we are talking of Q4. So the revenues of Q4 for FY22 would be in the range of about 31 crores as compared. This is double than what we did in FY21 last quarter. The EBITDA is also was a negative of about 9 crores in the Q4 of last year, and that's come down to 4.7 crores in this quarter. And obviously, this is when we just got 3 days of international flights, which started only on the 27th of March. What was your second question, Rajiv, on OFS?
Sir, the utilization here, in the sense, what is the utilization where you're clocking right now, in the sense the latest month or last quarter?
Yeah, so utilization is hovering around 50%, but the important thing is that the mix of that is more domestic, as you would recall. And domestic business, obviously, domestic airlines come at a much lower profitability. So, yeah, if that answers your question. And also, just to add that our new flight kitchen in Mumbai, we just capitalized it on the 1st of January.
And when do we break even, in the sense that what util on domestic side do we break even?
No, it's a combination. Like I said, that, when international travel increases, it's not a straight kind of formula like the hotel business, because it's a mix of the international and the domestic business, and that's completely skewed in terms of profitability when you look at international coming in heavily. So there isn't one level that we can say. It has to depend on the mix. And if, let's say, what it was earlier, which was 90% international travel, then by now we would have the break-even would have been achieved.
Yeah, this is very helpful, sir. Thank you.
Thank you. So we have a couple of questions in the chat box. Firstly, Kallol, if you can take the first two questions. Firstly, how much of the cost control can remain when things open up? Do you need to hire back again when occupancy picks up? And any thoughts on ability to hire in current times? That's the first question. And yeah, Kallol, maybe you can take the first one. I'll say the second one after that.
Sure. So as I mentioned earlier during my presentation, that our fixed costs are down by about 16%. I'm sure the math can be done. In a normal year, about 70% of the costs used to be fixed costs. And when we are talking of a 16% reduction, it's easy to derive the numbers there. I think in 2021, the reduction was a little more in terms of the fixed cost, which obviously with increase in business levels in 21-22, there is obviously recruitment that has happened back, and numbers have started going up. We anticipate that we will be able to retain a large part of it, but it also depends on the mix of business, and it also depends on the pressure that the hotels are seeking. And it's also a conscious strategy for the company to improve the work-life balance. And as a result of that, even if it makes financial sense to have lower numbers, the organization has taken a conscious call to really make sure that hotels are adequately and evenly staffed, so that, really speaking, there is less stress on people, and with increasing volumes of business. So some percentage of that will come down, but we still believe that a large percentage of the saving will continue to remain. On the recruitment bit, maybe Vikram, you can add. I mean, I can talk about some of the functions that are not front of the house. So there, of course, there is much more competition than what it used to be in the past, which are really industry agnostic functions. But in terms of operations, I don't think there is a significant change. Mr. Vikram Oberoi can really add to what I'm saying.
And actually, I would say that at our hotels, it is becoming more difficult to find the quality of people that we'd ideally like to have. So we just have to work a lot harder to attract and to select. And I'm talking about, even entry-level positions. So these are people who are very, very important to our guest experience because they're the people that interact most with our guests. And our selection criteria is never to select for a position. It's our selection based on the ability of the person to grow at least 2 levels. So that is entry level, supervisory, and manager. So when you interview me, you should ask the question, does Vikram have the potential to become a manager in time at an Oberoi hotel or a Trident hotel or even outside our company? And with that criteria, we are seeing that it is more difficult to more difficult in the selection process.
And second question, Kalol, if you can highlight what's the contribution from MICE pre-COVID and how is it today versus pre-COVID? Any contribution from MICE?
So, well, MICE also is really speaking what we look at income. See, it's not really about MICE or any segment kind of contribution. It depends on which channel it's being received from. So let's say if the business is from a direct channel, which is, let's say, an OTA, for instance. In this case, MICE will obviously not be much to the OTA channels. So, Vikram, would you like to hazard a guess on the margins on MICE business?
The margins?
No, this is a revenue contribution.
Oh, the revenue contribution on the whole, is it?
That's right. From MICE pre-COVID and how is it today versus pre-COVID?
Okay, so that was, if I'm not wrong, pre-COVID, Vikram, would be around 20% in case of MICE?
20-25% is my guess.
Now it's beginning to pick up. It had really gone down, and my guess is it would be in the range of 12 to 13% at the moment.
Yeah. And again, you need to break this up into really 2 parts. One is leisure hotels, and the other one is city hotels. So leisure hotels, even during COVID, in fact, hotels that had never done social events before started getting that business because it's high-paying business. Weddings were small. There were restrictions on size. So you saw hotels that, even a 100-room hotel, even a 71-room hotel, Rajvilas, started getting weddings. And Rajvilas is in a location where there are no hotels that are in close proximity to Rajvilas of that standard. But we benefited from that because wedding sizes were restricted with COVID. So I think it's very hard to just apply, the same brush. What we've seen is what I anticipate is going to happen is in leisure hotels, actually, the MICE contribution is going to come down. And what I see in our city hotels is MICE contribution is going to go up.
Sure. And just last couple of questions that we've received in the chat box. So Vikram, sir, maybe you can take that. Firstly, we are hearing across the industry that demand is dominating supply heavily for the hotel industry. So as compared to the FY03 to FY07 phase, which was a golden phase for the industry, how's the current scenario and can we see a similar phase for the industry over the next 4 to 5 years? That's the first question. And second, Reliance as a shareholder, so what are the long-term thoughts on that? I think that is the last question.
So I think the first question is, your ability to predict what's going to happen over the next 3 to 5 years is probably as good, if not better than ours. What we know is that demand is at least so far strong, and it's still early days. We've seen strong demand in March and April for in our city hotels. We hope that will continue. We also know there's not a lot of supply that is coming on board in the next few years. So demand is strong, then you will see rates and occupancies go up. Whether that's as good as it was, I can't tell you. What I can tell you is what I said before. In April, a number of our hotels outperformed their previous numbers. So forget about 19, 20, but even prior to that. So they did very well. I can't tell you whether that's going to continue for the next 5 years or not. But I think, again, what we need to look at is what's happening. If we expect demand to be strong, what we know is supply is limited. And if demand is strong, supply is limited, occupancies and rates will go up. I also wanted to say one other thing, and again, I have no data to... I have no data...
Mr. Rajiv, sorry.
Yeah, I have no data to support this, but just in talking to our guests, I think with COVID, people will go to brands and hotels that are recognized for quality, because safety is probably more important than price. And I think hotels that are of high quality, enjoy a high reputation, will reap the largest benefit. Now, do I have data to suggest this? No. I know if I were to travel, that's what I would do. And I assume our guests will do the same. So that's the other thing I wanted to mention.
Sure. And perhaps the second question on your thoughts on Reliance being a long-term shareholder.
So Reliance is an absolutely fantastic partner. They have board representation, and other than that, I have no further comment. But they are extremely supportive, as is the rest of our board, and we value the advice and the guidance of the EIH board and of the Reliance directors in that.
Sure. So that was the last question. So any closing comments that you'd like to make?
No. Well, what's nice is, Karan, is that there seems to be, and people on this call talk to other hotels and other hotel companies, and what's encouraging is that there is a wide sense of optimism on future demand, and which is good for our industry. So this is not something that is just our perception, but it seems to be a perception that you hold and our other hotel partners hold. So I think that is good for our industry. More important than that, it's good for tourism. And tourism is such a large employer and has the potential to employ so many people, which is our greatest need in India, is to create employment. So if these trends continue, our industry and the travel and tourism industry will employ more people, which is a real benefit to our country.
Great. Thank you, Mr. Vikram and Mr. Kalol, for taking our time and answering everyone's questions so patiently. On behalf of Ambit Capital, I wish you all the very best, and thank you everyone for joining the webinar. You may now disconnect your lines.
Thank you. Thank you.
Thanks so much, Karan. Thank you, everyone.
Thank you.
Thank you. Bye-bye.